We are going to learn about closing entries. Closing entries are a special type of entry. The purpose of a closing entry is to change all of the temporary accounts back to zero. So what we're really doing with closing entries is what we already did on the financial statements. On the financial statements, on our statement of retained earnings, we started with our beginning retained earnings. We added net income and subtracted dividends to get ending retained earnings. That's what we're going to do now on our books with closing entries. So the first thing that we have to do is we have to identify what accounts we're going to close. We're going to close all of the temporary accounts. The temporary accounts are revenue, expenses, and dividends. Now, you don't have to actually memorize that, because if you think about it, revenue has to start over at the next year, and expenses have to start over at the next year. But cash wouldn't start over. You wouldn't say, oh man, I wish I'd bought that December 31st because now it's January 1st and we had to reset cash to zero. So the reason we reset revenue and expenses and dividends and put them into retained earnings is because otherwise the numbers wouldn't be very meaningful. If I asked you how much revenue did we earn, you're like, oh man, yeah, $15,237,459. And I'm like, wow, that's been an amazing month. And you're like, oh no, that's the last 5 years. It wouldn't be very useful. We're going to use a really temporary account called income summary. The entire purpose of income summary is to kind of be a check figure. You can actually do the closing process without using income summary, and you simply put everything directly into retained earnings. So these are your temporary accounts: revenues, expenses, dividends, and income summary. These are your permanent accounts: assets, liabilities, retained earnings, and common stock. The only accounts that are going to be affected are going to be the temporary accounts. They're the only ones we're going to do anything with. Here's the 4 steps. We're going to close the credit balances in revenue to the income summary account. So what I mean by close is whatever the account balance is, we're going to make it zero. So we're going to move revenue to income summary. We're going to move expenses to income summary. We're going to move income summary to retained earnings and put dividends in retained earnings. Now, when we're done, what we've really done is we've put the revenue and the expenses into retained earnings. So revenue and expenses is the same as net income. So we've really put net income into retained earnings and taken dividends out. So this is why it's so easy. So if you look at the expense accounts, like here's depreciation expense. So originally it's an expense, so it has a debit balance. So if it has a $300 debit balance, how do we make it zero? We have to credit it. Salary expense started with the 1610 debit balance. What do I have to do to make it zero? I have to credit it. So I'm going to credit each one of these accounts. So I'm going to credit each account. My journal entry is going to have a credit to depreciation expense, one to salary expense, one to insurance expense, one to rent expense, one to supplies expense, one to utilities expense. And then we're going to add it all up. We're crediting these, and we're going to debit the income summary account. Now, the next thing that we're going to do is we're going to close revenue. So here's revenue. Revenue has a normal credit balance. So what do I have to do to make consulting revenue zero? I have to debit it. And what do I have to do to make the $300 credit and rental revenue zero? I have to credit it. So I'm going to credit consulting revenue, and I'm going to credit rental revenue. I'm going to add them together, and I'm going to debit income summary $8,150. Now, the reason we use this income summary account is because it's a good check figure. If this side, if $8,150 is my revenue and $4,365 is my expenses, and my balance is $3,785, what is this number a check figure with? This is my revenue minus my expenses. Where else am I going to see the number 3785? At the bottom of my income statement. That's going to be my net income. So now I need to make my income summary account 0. So I have a balance of 3,785 credit. To make it 0, I have to debit it. So I'm going to debit my income summary account, and I'm going to credit retained earnings. So I just put my net income into retained earnings. I increased retained earnings by the amount of my net income. I'm going to take dividends. So dividends has a $200 debit balance. I need it to be 0. So I'm going to credit it $200. I'm going to credit dividends, and I'm going to debit retained earnings. So when I look at my retained earnings account, I have my beginning balance plus my net income minus my dividends gives me my new balance. This is the balance that you will see on the balance sheet, because what I've done in this retained earnings account is exactly what we did in my statement of retained earnings on my financial statements. A post-closing trial balance is simple. All you're doing with the post-closing trial balance is you're recording the numbers that go in your trial balance, but it won't have any of the temporary accounts because those are all 0. So that's why once we get to retained earnings, we don't have any revenue accounts, we don't have any expense accounts, and we don't have any dividends because we just made them 0 in the closing entries. All right, next up is practice.